All right, we are diving into a definitive review of 5 pro-level write-offs that every single LLC owner needs to have on their radar for 2026. Look, this isn't just about saving a couple of bucks here and there. This is about a fundamental shift in how you look at your business finances. Let's get right into it. This quote right here, it says it all. This is exactly what's at stake. We're not talking about rounding errors or small change. We're talking about tens of thousands of dollars or even more just being left on the table every single year. So the question is, why is this happening? Well, it really boils down to one simple concept: playing tax defense versus playing tax offense. You see, most business owners are stuck on defense. They're tracking their expenses, they're saving their receipts, and they're basically just crossing their fingers and hoping for the best when tax time comes around. It's totally reactive. The real game, where the serious savings are, is in playing offense. It's about being proactive, strategically structuring your LLC to legally turn personal expenses into business deductions. And that's exactly what these 5 strategies are all about. This video contains affiliate links. Before we break down the top 5 massive tax write-offs you need to be claiming in 2026, let's talk about the foundation. You absolutely cannot maximize your deductions or bulletproof your tax strategy without a properly structured business entity. Most people try to run their operations as a sole proprietor, mixing their personal and business expenses together, and that's exactly why they miss out on thousands in legitimate write-offs or trigger an IRS audit. To legally claim these deductions, your business needs to be a legitimate, separate legal entity in the eyes of the IRS. That's where Busy comes in. Busy is the absolute best service out there, handling your entire LLC formation for just $0 plus state fees. They take care of all the heavy lifting for you, filing your articles of organization, providing your required registered agent service. Securing the EIN, you absolutely must have to open a dedicated business bank account, which is the secret to cleanly tracking these write-offs and setting up your compliance alerts. They give you the exact legal framework required to protect your assets and lower your tax bill. This is non-negotiable if you want to keep more of your own money this year. I've put a special link in the description below. Use my link to get your LLC set up right through Busy today and unlock some exclusive discounts and perks. Get your legal foundation handled first, and then let's get into the write-offs. All right, let's pop the hood and get into the technical teardown of each of these strategies. We're gonna look at exactly how they work, what makes them so powerful, and the nitty-gritty of what you need to do to get them right. First up, strategy number 1, the Augusta rule. The idea here is actually beautiful in its simplicity. So there's this piece of the tax code, section 280A, that lets you rent your personal home to your own business for up to 14 days a year. Here's the kicker. The business gets a tax deduction for the rent it pays, but for you, the homeowner, that rental income is completely 100% tax-free. It's just a brilliant legal way to move money from your business pocket to your personal pocket. But, and this is critical, you have to do this by the book. It's not a free-for-all. You've got to follow these 4 steps. First, do your homework and find out the fair market rental value for a place like yours. You can check sites like VRBO. Second, you absolutely must document a legitimate business purpose, something like a quarterly planning session. Third, draft a formal rental agreement between you and your LLC. And finally, you actually make the payment from the business bank account to your personal one. Documentation is king here. So what does this look like in dollars and cents? Let's just run a quick example. Say your home could rent for $1,000 a day on the open market. You use it for business meetings for 12 days out of the year. Your LLC pays you $12,000, which it gets to write off. And you get $12,000 in your personal account, totally tax-free. It's an incredibly efficient way to pull profit out of the business. Now, let's move on to the next tool in the suite, hiring your children. This is just a classic, brilliant income-shifting strategy. The idea is to pay your kids, who are under 18, a reasonable wage for real work they're doing for your business. What you're doing is moving money from your high tax bracket, maybe 30 or 40%, down to their tax bracket, which is often 0%. And again, the process is everything. You need to create a real job for them, like handling social media or organizing the office. Then pay them a reasonable wage for that work, what you'd pay anyone else, and you have to track their hours. But here's the killer bonus move. Once they have that income, you can help them open a custodial Roth IRA and fund it, up to $7,500 in 2026. That money can then grow tax-free for decades. It's incredible. Just look at the potential impact here. Your business could get a $16,000 deduction for the wages it pays. Your child gets that $16,000,
And it's free from federal, state, and even FICA taxes. You've just created a $16,000 tax-free wealth transfer inside your own family.
Strategy number 3 is all about speed. It's called 100% bonus depreciation. And what it does is let you deduct the entire purchase price of qualifying assets. We're talking equipment, machinery, software, even heavy vehicles over 6,000 pounds, all in the first year you buy them. And get this, you can do it even if you finance the purchase and haven't paid it all off yet. Now, this is a really crucial update you need to know about. Recent legislation called the One Big Beautiful Bill Act actually restored the 100% bonus depreciation rate and made it permanent. This is a total game changer, because under the old rules, this incredible deduction was being phased out. So for any qualifying stuff you put into service after January 19th, 2025, you can take that full 100% write-off. Okay, number 4 is the Qualified Business Income Deduction, or QBI. Honestly, this is just a fantastic write-off. For LLC and S-Corp owners who qualify, it lets you deduct up to 20% of your business income right on your personal tax return. It's basically a tax break you get just for being a business owner. But, and this is a big but, there are income limits you have to watch out for. For 2026, this amazing deduction starts to disappear if your taxable income goes over about $276,000 as a single filer, or $553,000 if you're married. And this is exactly where playing tax offense comes in. You can use the other deductions we're talking about to strategically lower your income, keep it under these limits, and snag that full 20% benefit.
And finally, our 5th strategy, strategic business travel. This might be one of the most powerful but also most misunderstood write-offs out there. The whole key is to structure your trip so you can legally and ethically turn what would have been a personal vacation into a tax-deductible business expense. The rule is actually pretty straightforward. If your trip includes legitimate business activities on the weekdays, the whole thing can become deductible.
So what does that actually mean for your wallet? Well, when a trip qualifies, you can write off 100% of your flight, 100% of your hotel for the entire trip, and 50% of your business-related meals. The savings here can be absolutely enormous. Okay, so theory is great, but how does this stuff actually perform out in the wild? It's time for the field test. Let's look at some real-world business scenarios.
These examples really bring it to life. I mean, look at the gym owner in Dallas who bought $4 million in new equipment. By using 100% bonus depreciation, he saved an estimated $1.5 million in taxes. Or how about the Miami birthday trip? A 5-day personal getaway was turned into a fully deductible business trip just by scheduling a few client meetings on the weekdays. And then you have the simple elegance of the Augusta rule, used to create $12,000 of tax-free income just from holding meetings at home. Now, as incredible as these strategies are, you absolutely cannot just jump in blindly. They have to be used correctly. So let's move into a critical evaluation and have an honest look at the risks versus the rewards. On the one hand, the rewards are just huge. We're talking 5-figure tax savings, turning personal costs into deductions, and shifting income into 0% tax brackets. But on the other hand, the risks, you have to take them seriously. One wrong move, one misstep, can trigger an audit. Failing to document your travel, mixing personal and business funds, or trying to deduct something that's purely personal, that will land you in hot water. You have to remember this rule. If you do one of these strategies 50% right, in the eyes of the IRS, it's 100% wrong. So, all of that brings us to the final verdict. After breaking it all down piece by piece, is this pro-level toolkit really the right choice for your LLC? Here it is. The bottom line is that this suite of 5 write-offs is an incredibly powerful, high-performance toolkit, period. But it is not for the passive or the disorganized business owner. It demands discipline, it demands meticulous documentation, and it demands a proactive mindset. But for that LLC owner who is truly willing to play offense with their taxes, the return on investment is without a doubt massive. And really, that just leaves us with one final question for you to think about. I want you to take a hard look at your own strategy. Are you still playing that reactive game of tax defense, just hoping for the best? Or, after seeing what's really possible, are you ready to play offense?